Imagine a world where sending money, say across continents, is basically as quick and easy as sending an email,
Hmm.
where payments can be instantly programmed, to happen exactly when certain conditions are met,
Right, automated.
or where managing a company's finances happens in real time, 24/7. Sounds a bit like science fiction, maybe.
It really does, but it's becoming reality.
Well, today we're diving deep into stablecoins, these pretty fascinating digital assets that are genuinely starting to reshape the global payments landscape, making that future, well, much more present.
That's right. And our mission here really is to cut through the jargon. There's a lot of it.
There is.
We want to get straight to the core insights from the source material we've looked at.
Mhm.
We'll unpack what stablecoins actually are, how they work, how they keep that stability.
Yeah, the stable part.
Exactly. And their benefits, which are pretty incredible, but also the significant risks they carry. And of course, how regulators across the globe are, frankly, scrambling to keep up. The idea is that by the end, you'll feel really well informed on this whole rapidly evolving area.
Great. So let's start right at the beginning, the absolute basics. What is a stablecoin?
Okay.
Because they're not like Bitcoin, right? Right. Which can just swing wildly in value.
Not at all. Stablecoins are engineered specifically to minimize that price volatility.
Engineered. Good word.
Yeah, their main design is to peg or, tie their value to something stable. Usually that's a fiat currency like
Right.
the US dollar,
Most common one.
but sometimes it can be commodities, gold maybe, or other financial instruments.
Okay, so they're anchored.
They're anchored. And what's really key here is their core value proposition. They somehow manage to combine the stability, the reliability of traditional money
Mm-hmm.
with the kind of inherent efficiencies you get from blockchain technology.
Okay. Break that down. What efficiencies?
Well, think about it. Really rapid transaction speeds, much lower cost than traditional systems,
Yeah.
enhanced security in many ways, and they're available 24/7, 365.
Always on.
Always on. They effectively bypass the old banking intermediaries. They act like a digital, tokenized form of currency that you can program and settle almost instantly.
Wow.
And their emergence, it was really a direct response to Bitcoin's crazy price fluctuations. That volatility limited its usefulness for, just buying a coffee.
Yeah, you couldn't rely on it day to day. But here's where I think it gets really interesting. Beyond just speed and cost,
Go on.
this idea of stablecoins transforming money itself into a programmable internet native layer.
Yes.
One source put it really well. It makes sending money like sending an email. Simple.
It's a great analogy.
But it's more than that, right? It means you can embed logic, automation directly into the money.
It's exactly into the monetary unit itself.
So suddenly you can have automated transactions, complex financial instruments, all running on these things called smart contracts.
It's like giving money a brain, as you said. It can execute instructions based on pre-agreed conditions.
Okay, so the promise is huge. Money that basically acts like the internet.
Mm.
But how? How do they do it? How do they stay stable?
Right. The million-dollar question, or maybe the $1 question in this case.
Yeah.
It really boils down to how they're backed up, their collateral structure. Our sources point to 4 main types, but they all share that one goal: price stability.
4 types. Okay, let's walk through them.
Sure. So the most common type you'll see are fiat-backed stablecoins.
Yeah, okay.
These maintain a one-to-one peg, usually with a traditional fiat currency, most often the US dollar.
Like USDC, Tether.
Exactly. For every digital token, say 1 USDC, there's supposed to be 1 actual US dollar, or something equivalent like short-term government securities or cash deposits held in reserve.
Supposed to be. We'll get to that.
We will. And crucially, these reserves are typically kept in segregated accounts,
Meaning?
meaning they're kept separate from the issuer's own operational funds. They shouldn't be lent out or rehypothecated, used for other purposes with some narrow exceptions. They're there purely to back the stablecoin.
So you can redeem it.
So you can redeem your stablecoin for the underlying fiat. Now, the issuers often invest these reserves.
So they make money off the float.
Precisely. They earn yield on the reserves, but that yield generally goes to the issuer, not the person holding the stablecoin. Tether, USDT, USD Coin, USDC, Gemini Dollar, GUSD, those are the big names here.
Okay, so it's basically like a digital claim check for real money held somewhere safe. Mostly.
That's a good way to think about it. But what about stablecoins that aren't backed by dollars or euros?
Right. What's next?
That brings us to crypto-backed stablecoins.
Okay, backed by crypto. Isn't that volatile too?
It is. And that's the key challenge. So instead of fiat, they're collateralized by other cryptocurrencies, like Ether.
Right.
But because those underlying cryptos, like Ether, can swing in price, these stablecoins use a mechanism called over-collateralization.
Over-collateralization, meaning more collateral than the loan, basically.
Exactly. You might have to lock up, say, $150 worth of Ethereum in a smart contract just to mint $100 worth of the stablecoin.
A buffer.
A buffer, exactly. To absorb price drops in the collateral, algorithms constantly monitor these collateral ratios to maintain the peg. DAI is probably the most well-known example, primarily backed by Ether and other digital assets now too.
Okay, so trust shifts from a company holding dollars to code managing crypto assets.
In essence, yes. More decentralized, arguably, but you're trusting the code and the collateral management. And then you have the really different ones, algorithmic stablecoins.
Ah, these are the controversial ones, right? Especially after Terra Luna.
Extremely controversial, and yes, Terra's collapse is the cautionary tale. These are unique because they don't rely on traditional collateral like fiat or even over-collateralized crypto in the same way.
So what backs them? Thin air.
Well, not quite thin air, but code and economic incentives. Their price stability is supposed to be achieved entirely through specialized algorithms and smart contracts that automatically manage the token supply.
How does it work?
If the stablecoin's price drops below its peg, say 0.99 down, the algorithm automatically reduces the supply, maybe by burning tokens or incentivizing holders to exchange them, creating scarcity to push the price back up.
And if it goes above $1?
If it goes above, say, $1.01, the system mints new tokens to increase supply and bring the price back down. Terra, UST, and LNA used a dual token system like this.
Which failed spectacularly.
Which failed spectacularly when the market lost confidence and the algorithm couldn't defend the peg, leading to a death spiral.
Right, so that collapse really hammered home the fragility there.
It absolutely did.
So if we look at these types together, it seems like a spectrum, right? Defined by where you place your trust and how decentralized it is.
That's a perfect way to put it. Fiat-backed are fundamentally trust-based. You trust the centralized company, the issuer, to hold those reserves. That introduces counterparty risk. What if the company fails? Crypto-backed shifts that trust more towards the transparent code, the smart contracts on the blockchain. More decentralized, but then you have smart contract risk. What if there's a bug?
Right. Code isn't infallible.
And algorithmic stablecoins are way out on the furthest end of that decentralization spectrum. They rely purely on the code and incentives. But as Terra showed us, they've historically proven, let's say, quite fragile.
Very fragile.
And it's worth noting, these technical differences, how they maintain the peg, they aren't just academic. They directly drive how regulators think about them. The rules, the stringency, what counts as safe and compliant.
That makes sense. The risk profile is totally different. Okay, let's shift gears then. We know how they work, roughly. Let's get to the exciting part. Where are they actually being used? How are they transforming payments now?
Right, the real-world impact.
Yeah, the general benefits seem clear, near-instant, low-fee transactions, global, 24/7, better financial access.
Absolutely. And one of the most immediate, dramatic use cases is cross-border payments and remittances.
Fixing Western Union, basically.
Well, addressing the issues with the traditional system, yes. It's notoriously slow, expensive, and often inaccessible for many. Get this. In 2023, the average global fee for sending remittances was over 6.6%.
Wow, that's high.
It is,
Yeah.
especially for people sending small amounts home. Stablecoin transactions, on the other hand, typically cost less than $1 in network fees, sometimes pennies.
Less than $1 versus 6.6%? That's huge.
It's massive, and they settle in minutes, not the 1 to 3 days it can take for a traditional SWIFT bank transfer, which itself can cost $25 to $50.
Right.
We're seeing real examples like USDC being used in Latin America via platforms like Bitso on networks like Stellar or Polygon, or mobile apps like coins.ph in the Philippines reaching people who don't have bank accounts.
The unbanked or underbanked.
Exactly. It's really about democratizing global finance, opening it up.
So it's not just a small improvement. It's like going from horse-drawn carriage to email for sending money internationally.
That's a good comparison. And beyond remittances, they're starting to make inroads into merchant transactions and everyday purchases.
Paying for things online or in stores.
Potentially, yes. For merchants, the appeal is significantly lower transaction fees compared to credit cards.
Which can be like 2–3%?
Easily. And much faster settlement. They get their money quicker. For consumers, especially those without bank accounts or credit cards, it's a reliable digital payment method. Solana Pay integrating USDC is a notable step here.
Interesting. And what about businesses? B2B payments?
Big potential there too, especially in corporate treasury and B2B payments.
Hmm.
Think near real-time settlement for large transactions, much cheaper fees, and better traceability on the blockchain.
And that programmability aspect must be key here.
Absolutely. This is where programmable money really comes into its own. Automating payments, settlements, payrolls, all directly from a company's treasury wallet using smart contracts.
Set it and forget it, almost.
To an extent. Plus, companies can use stablecoins to earn yield in DeFi protocols.
Right, you mentioned that, like a money market fund, but on the blockchain.
Yeah. Sort of, yes. Or hedging against foreign exchange volatility, especially in emerging markets where the local currency might be unstable.
And we're seeing big names jump in, right? I remember reading about Siemens using JPM coin.
Yes, for automated internal transfers. PayPal used its own PYUSD stablecoin to pay an invoice to Ernst & Young.
Wow.
Citi and Maersk are automating bank guarantees. Société Générale in France launched a euro-pegged stablecoin, EURCV. Japan's 3 biggest banks are piloting stablecoins. Stripe rolled out stablecoin settlement options in over 100 countries.
Okay, so this isn't just theory anymore. This is major financial players actively using this technology.
Exactly. That programmability, it's a foundational shift. It enables completely new business models because you can embed complex financial logic. If this happens, then pay that amount directly into the payment itself.
So supply chains, payroll, even payments from like smart devices.
Potentially, yes. IoT-driven payments, things could become highly autonomous.
Mind-bending stuff. And what about DeFi? Decentralized finance.
Stablecoins are absolutely a cornerstone of DeFi and broader financial services.
How so?
While DeFi involves things like lending, borrowing, trading, all without traditional banks or brokers, run by code, stablecoins provide the stable medium of exchange needed for these decentralized applications, or dApps.
So you're not trying to borrow or lend in something super volatile like Bitcoin.
Precisely. You use stablecoins for collateralized loans, for liquidity pools that enable trading between different crypto assets. They act as a stable store of value within that ecosystem.
A safe harbor in the crypto seas.
A safe harbor and also an accessible entry point for people wanting to access global financial markets or earn yield in protocols like AI or Compound with more predictable returns. They're even bridging TradFi and DeFi, like tokenizing government bonds so they can be used in these new systems.
Incredible range of applications. It sounds almost too good to be true. Which usually means
there are risks, significant ones.
Okay, let's unpack those.
Yeah.
Because the potential is huge, but we need to understand the challenges.
Absolutely. Number one is probably financial stability and depegging risks.
Right, the stable part isn't guaranteed.
It's not. Especially for fiat-backed ones, it all hinges on the quality and the transparency of how those reserves are managed. There's serious counterparty risk.
Meaning the issuer might not actually have the reserves they claim, or they might go bust.
Exactly. They might fail to maintain that 1.1 backing, and they are absolutely susceptible to runs, just like traditional banks.
Like a bank run, but on a stablecoin issuer.
Precisely. Remember when Silicon Valley Bank was collapsing in 2023? Circle, the issuer of USDC, tried to withdraw $3 billion of its reserves held there. That caused USDC itself to temporarily lose its peg. It shows even the big, well-regarded ones aren't immune to wider system shocks.
Wow, yeah, that linkage is critical.
And as we already discussed with Terra, algorithmic stablecoins, well, they've historically proven very, very difficult to sustain successfully without failing spectacularly.
Okay.
Without robust regulation, these risks really undermine their claim to be sound money.
So digital doesn't mean immune to old-school financial panic.
Not at all. Then you have security, custody, and fraud concerns.
Protecting the actual digital assets.
Yes, safeguarding them from cyber attacks, theft. It's a massive challenge for everyone involved, from big institutions to individuals. And the nature of these payments adds another layer of risk.
How so?
They're generally irreversible, immutable, and immediate. Once you send stablecoins on a blockchain, getting them back if you made a mistake or got scammed is difficult, often impossible.
Unlike a credit card chargeback or reversing a bank transfer sometimes.
Exactly. So this creates heightened fraud risks, credential theft, people impersonating others, romance scams, fake invoices, all the usual scams, but potentially with no recourse.
Ouch. Okay, what else?
Well, tied into that are compliance and illicit finance risks.
Money laundering, terrorism
It's
financing.
the usual suspects. Because stablecoins can function like digital bearer instruments, like digital cash, and operate on borderless public blockchains, sometimes with weak identity checks.
Pseudonymity.
Right, pseudonymity rather than full anonymity, but still. This makes them attractive for illicit uses, like laundering money or evading sanctions. Banks and platforms dealing with stablecoins need really robust compliance systems, adapting traditional AML/KYC processes for this new world.
So the very features that make them useful speed, global reach, also create risks.
It's a double-edged sword. We also face scalability and interoperability challenges.
Meaning the technology can't always keep up.
Partly, yes. Blockchains can get congested, slowing transactions down or making fees spike. You hear about the blockchain scalability trilemma.
Vaguely. Speed, security, decentralization, pick two.
Essentially, yes. Improving transaction speed and volume often means compromising on decentralization or security. Also, money can get fragmented. You might have USDC on Ethereum, USDC on Solana, USDT on Tron. They don't always easily talk to each other.
Silos.
Silos, exactly. And not all stablecoins work with all digital wallets, which can lead to confusion or even loss of funds if you send them to the wrong place. Things like Layer 2 networks and cross-chain bridges try to fix this, but it's an ongoing challenge.
Okay, tech hurdles. And then there's the big geopolitical one you mentioned earlier.
Yes. Monetary sovereignty and digital dollarization concerns. This is a big one for governments.
Explain that again.
So USD-backed stablecoins utterly dominate the market, like 99% of it.
99%.
Yeah. If people and businesses in another country start widely using these USD stablecoins instead of their own local currency.
Like what happens in some countries with physical US dollars.
Exactly. It's the digital version of that digital dollarization.
Yeah.
This can seriously weaken that nation's own monetary policy. It makes it harder for their central bank to manage inflation or stimulate the economy, and it undermines their foreign exchange controls.
So they lose control over their own economy, essentially.
It's a direct threat to their monetary sovereignty. Now, the flip side is, in countries with really high inflation, these stablecoins can be a lifeline, a way for people to protect their savings from devaluation.
So a benefit for individuals, but a risk for the nation state.
It's a complex trade-off. And just briefly, there are other economic challenges too.
Go on.
If loads people pull money out of traditional bank deposits to hold stablecoins, that could shrink the deposit base for banks, potentially reducing their ability to lend.
Affecting credit availability.
Potentially. Also, remember how issuers make money from reserve yields? If interest rates fall really low, that revenue stream dries up, which could make the whole stablecoin model less viable for some issuers.
Okay, so a whole raft of risks. Financial stability, security, illicit use, tech limits, sovereignty, economic impacts. It's clear why regulators are getting involved.
Absolutely. Given the risks and the sheer speed of growth, regulation is crucial. And there seems to be a global consensus emerging, broadly speaking.
What's the consensus look like?
Generally, regulators agree it needs to be comprehensive, consistent across borders where possible, risk-based, treating different stablecoins differently based on their structure.
Right, fiat-backed versus algorithmic.
Exactly. Flexible enough to adapt to new tech and technology neutral, focusing on the activity and risk, not the specific tech used.
Makes sense. So who's taking the lead?
Well, the European Union has definitely been a pioneer with its markets in crypto assets regulation, or MiCA.
MiCA. Heard a lot about that.
Yeah, it's a landmark piece of legislation.
Yeah.
It aims to establish uniform rules across the entire EU, tackling things like market abuse, financial instability, and protecting consumers.
And what does it say about stablecoins specifically?
It has very stringent provisions for stablecoins, which it calls asset reference token, RTs, those backed by a basket of assets, and e-money tokens, EMTs, those pegged to a single fiat currency like the euro or dollar. It mandates transparency about reserves, requires sufficient liquid reserves, demands robust redemption rights for holders, and sets operational safeguards. It also puts clear accountability rules on the companies providing crypto services, CASPs, and gives investors legal recourse if things go wrong.
When does that kick in?
It's already entered into force, but the stablecoin rules fully apply from mid-2024, with the rest applying later. We've already seen its effects. Binance, for example, pulled out of some EU countries like the Netherlands and Cyprus, partly due to difficulties meeting MiCA's requirements.
So it has real teeth. What about the US? Are they doing something similar?
The U.S. approach is still developing, more fragmented maybe. There's proposed legislation like the Clarity for Payment Stablecoins Act of 2023, sometimes called the Genius Act.
And what's the goal there?
The aim is to create a federal framework specifically for payment stablecoins. Importantly, it tries to clarify that these are not securities or commodities, placing them under banking regulators.
Ah, settling the jurisdictional question.
Trying to, yes. And it sets pretty strict requirements. Only permitted payment stablecoin issuers could operate, think subsidiaries of banks, or state federally qualified non-bank issuers.
So tightly controlled issuance.
Very. It mandates 1.1 backing with high-quality liquid assets, cash, short-term treasuries. Reserves must be segregated, no rehypothecation.
Like MICA.
Similar principles. Public disclosure of redemption policies, monthly attestations on reserves examined by accounting firms, certified by the CEO, CFO.
Wow, quite detailed.
And it designates issuers as financial institutions, meaning they fall under strict anti-money laundering, AML, and Know Your Customer, KYC rules via the Bank Secrecy Act.
Makes sense given the illicit finance risks.
One really interesting point in this proposed U.S. bill is that it explicitly prohibits paying interest or yield directly to stablecoin holders.
No yield. Why?
The thinking seems to be to make them function purely as payment instruments, like digital cash, and prevent them from looking too much like bank deposits or money market funds, which could trigger different regulations or destabilize banking.
Fascinating distinction. So U.S. and EU moving forward, albeit differently. What about international bodies? Are they trying to coordinate?
They are. The Financial Stability Board, FSB, which coordinates for the G20 countries, has issued high-level recommendations for global stablecoin arrangements. They emphasize consistent, effective regulation globally and a tech-neutral approach.
Setting global standards.
Trying to establish a baseline, yes. The Bank for International Settlements, BIS, often called the Central Bank's Bank, takes a more cautious, even skeptical stance.
How so?
They've argued that stablecoins, as they exist now, fall short of being sound money and pose risks unless tightly regulated. They advocate for a potentially more restrictive regime.
More restricted than FSB or MICA.
Potentially. The BIS has also floated the idea of central banks creating their own tokenized unified ledger systems, essentially hinting that central bank digital currencies, CBDCs, might be a superior, safer alternative controlled by central banks.
Ah, the CBDC discussion. That's a whole other deep dive.
It absolutely is. And finally, the International Monetary Fund, IMF, also weighs in. They acknowledge the contagion risks stablecoins could pose to the wider financial system.
What do they recommend?
Their recommendations focus on safeguarding monetary sovereignty, advising countries not to grant crypto legal tender status, like El Salvador did with Bitcoin. They also push for rules to manage capital flow volatility, address fiscal risks, enforce strong oversight, and crucially, foster international collaboration on regulation.
So a lot of global discussion, different perspectives, but a clear trend towards more regulation.
Definitely. The Wild West days seem to be ending.
Okay, so wrapping this up, we've seen the incredible potential of stablecoins, this idea of programmable money, making payments faster, cheaper, more global, more accessible.
Huge potential, yes.
But we've also dug into some really complex and significant risks. Financial stability, runs, security, illicit use, the challenge to national monetary sovereignty.
Absolutely critical risks to manage.
And we've seen how regulators worldwide, from the EU with MICA to the U.S. proposals and international bodies, are grappling with how to build guardrails around this powerful new technology.
It's a massive undertaking, trying to foster innovation while mitigating those risks. It's clear stablecoins are already changing how we think about money, how we use money.
For sure.
But here's something to maybe leave you, the listener, thinking about. If this widespread adoption of stablecoins, especially the USD-backed ones, is really pushing other countries, other central banks, to accelerate their own plans for non-USD stablecoins, or maybe even those CBDCs we mentioned.
To protect their monetary sovereignty, yeah.
Exactly. To compete, to retain control. What does that imply for the global financial landscape in, say, 10 or 20 years? Does it lead to more fragmentation or maybe more choice and decentralization? Or does it just create new forms of centralized control and competition between different national digital currencies?
A digital currency space race.
Perhaps. It's a fascinating question with no easy answer. What do you think the future holds there?